Dear friends, welcome back to PMS Insights. The last 3 months saw the Indian markets underperforming the global markets, with Nifty 500 index falling 11% versus 3% fall for MSCI World Index. This correction was largely led by concerns on domestic slowdown, with high-frequency data points like automobile sales, credit growth, and GDP growth continuing to show significant deterioration. While some of the recent measures announced by the government have not done much to improve the sentiments, it is encouraging to know that the government remains watchful of the current economic situation, and we are hopeful of positive developments on this front. Apart from removal of surcharge on capital gains, the finance minister announced a host of other measures to address interest rate transmission, availability of credit, and the auto sector slowdown. Also, the transfer of rupees 1.7 lakh crores dividend by the Reserve Bank of India will help in receding the investor concerns on fiscal deficit target in the light of weak tax revenue growth and steep divestment targets. We believe that policy intervention, improved monsoon, and expected further rate cuts should help improve sentiments, which could translate into growth over the next 2 to 3 quarters. Given the sharp correction in the markets, with around 60% of stocks down more than 20% from their near-term highs, incremental green shoots on improved liquidity and demand indicators could mean that the markets are close to bottoming out. However, rising global risk, escalation in US-China trade war, and US monetary policy risk, and also Chinese yuan depreciation could keep the markets volatile. Going forward, we believe that it would be a stock pickers market where high quality companies which continue to deliver healthy operating performance would outperform and deliver strong absolute returns over the next 2 to 3 years. Moving on to the financial performance for the first quarter of FY20, the earnings trend of companies reflected the broad slowdown in the economy, as the Nifty index saw a muted profit growth of just 2%. In this backdrop, the select sector portfolio companies delivered profit growth of around 30%, which is significantly ahead of the market growth, with 80% of companies delivering results either above or in line with estimates, and about 20% companies delivering results below estimates. Companies which delivered strong earnings growth include JK Cement, Phoenix Mills, Federal Bank, JK Paper, among others. New additions to the portfolio include Imami, Torrent Power, Federal Bank, Cummins, and Page Industries. In line with our investment philosophy, the return on equity and net profit growth for the portfolio are at 25% and 27% premium to the benchmark respectively on FY20 basis. Going forward, the portfolio might benefit on account of decent exposure to high quality companies with strong earnings growth visibility. Thank you.